Then prepare the forecast statement of profit and loss and other comprehensive income for the year ended 31st August 2025, showing the forecast profit for the year if Alesha decides to rent both the shops. So let's calculate the forecast profit. The revenue is going to increase by 60%, so 50,000 plus 60% of 50,000. So that value is going to be 80,000. Next, the gross profit as a percentage of revenue is going to remain unchanged. So gross profit over revenue, okay, is going to remain the same at 40%. This is the data given. But we saw that so what is the gross profit? New gross profit. Okay, revenue had increased by 60%. So I can say it is 1.6 times revenue. Okay, the revenue has increased by 1.6 times. Okay, that is equal to 40 by 100. Okay, so how did I write this 1.6 times? Because you can say revenue plus 60% of revenue. 60 by 100 is 0.6. So when you add those two, it will become 1.6 times the revenue. So that is equal to, okay, gross profit is equal to this becomes 0.4, 0.4, okay, times 1.6 times revenue. Okay, so that is equal to, we know what is the revenue, so 0.4 times 1.6 times revenue is going to be 50,000. So the initial revenue, so that is equal to 0.4 times 1.6 times 50,000. So that is equal to 32,000. So the new gross profit will be around 32,000. So let's write this value, 32,000. Okay, so this is the new gross profit that has happened because gross profit as a percentage is going to remain the same. Now from this we can calculate what is the cost of sales. So cost of sales, COS, is going to be equal to this revenue minus gross profit, that is equal to 80,000 minus 32,000. So that is equal to 48,000. So 48,000. So let's write here. So 48,000. So this was actually subtracted. Okay, revenue minus cost of sales will get me the gross profit which we had already calculated. Okay, now we had to do the expenses. More non-current assets will be purchased which will double the depreciation. So initially the depreciation expense was 1900. So 1900 times 2. Okay, the depreciation expense is going to increase by 2 times. So it is going to double. That is 3800. So 3800. Next we have the loan interest. So an extension of 5% bank loan will be required to 10,000. So already they had loan interest at 300. So further there is an extension of 5%. So let's calculate 5% of 10,000. Percentage of 10,000. So that is equal to 500. So the loan interest is going to become 500. Then other expenses including the rent is going to increase by 75%. So 1.75 times 8,600 we can write here. So 15, 15, 0, 50. Now let's add up all the total expenses. So the total expenses is going to become 19,350. Okay. So now we had to subtract from 32,000 minus 19,350. So the value for the forecast of profit for the year is going to be around 12,650. Next, we have part E. State 4 financial or non-financial factors other than profitability that Alesha will need to consider before making her financial decision to rent or not to rent the second shop. So the financial factors are liquidity of the business. Okay, we can say that she should consider liquidity of the business. Example, the how cash flow, we can talk about the cash flow, but like no other information, but here there is liquidity, there is no information available. You can also talk about the other than profitability, you talk about the liquidity of the business or the cash flow of the business. Okay, those will indicate the financial factors. And will the bank extend the loan interest rates could have increased to we have seen it can always increase. Then she should also consider non-financial factors, like the brand loyalty or the location of the business. These are non-financial factors to consider because the brand loyalty means increased. You can sell at a higher price, and the location of the business, if it's easier, then it will sustain for a helps to have good sales. Okay, location convenient for customers means they can have good sales. Evaluate whether Alesha should rent the shop next door and expand her business. So points in favor of expansion is you should talk about both financial and non-financial factor. Alesha's profitability was high as a return on revenue or capital employed possible opportunity to substantially increase the profit. So we can see that when she opens a door shop next door, already she is making profit. From that experience of success, she can have profit from this also. And non-financial factor is she could also extend the range of product and offer in this shop. However, non-financial factors however, the points against for expansion is she should also consider about the loan. Okay, because the projections are going to be just estimates. Whatever she has done here, this for opening of the next shop, okay, these are projections and they are estimates. It might not happen if the demand is affected. And also, does she have enough cash flow? Like we had discussed, bank loan interest might rise, or bank loan itself might not be available. Non-financial factors, expansion doubles the workload on Alesha because she will have to now work more, and there is a risk for the demand. If the demand is not sufficient, she will not be able to still make the sales and the revenue she had expected at 60%. She will need more resources like staffing and this thing and services. So it might increase a little cost, and also time might get increased. Okay, so then conclusion, Alesha should rent the shop next door and expand her business. So she will eventually get profit because she was always already was successful in the